All right, I wanted to do the quiz for chapter 3 and then I'll do one for chapter 4. I know that these are confusing chapters. They are the hardest chapters in the book. Well, 3 for sure. So just hang in there and we'll get through it. So for the first one, what we're doing is we're taking the unadjusted balance and we've done our adjustments here. So we want to get our adjusted trial balance. So cash will never change in an adjustment. You will never have an adjusting journal entry that involves cash. So I'm just going to keep that. Now, accounts receivable, we started with 5,800 and we added an additional 5,500. And I know that because our accounts receivable is a debit and I'm adding a debit. If I had a credit, I would subtract. So I'm going to start with 5,800. I'm going to add 5,500. So our new balance here is 11,300. Now with office supplies, we started with 250 and then we credited 220. So because we have a debit on office supplies and then a credit, I'm going to subtract. So office supplies normally sits on the debit side, but then we credited, so we subtracted. So we have office supplies of $30. Prepaid rent, I started with 2,600 on the debit side. It normally sits on the debit side, it's an asset. And I am crediting 1,300, so I subtracted 1,300 here. So I'm going to do that. Equipment, that will not change. You will always, you'll never see an adjusting journal entry for equipment. Now, accumulated depreciation, I had nothing, and then I had a $900 credit entry. So I'm going to do that. Accumulated depreciation does always sit on the credit side. And I'm not changing that. And again, with the depreciation, started with nothing and then credited 1,200. Accounts payable, that did not change. I have a credit balance of 5,000. Utilities, credit balance of 400. Salaries payable, I started with nothing. Now I have a credit of 5,400. Interest payable, same, 160. Now, unearned revenue, I started out with a credit balance because it's a liability, credit balance of 3,500, and then I debited 3,200. So I'm subtracting there, minus 3,200. So now, sitting on the credit side is 300 of unearned revenue. Notes payable did not change. Common stock did not change. Dividends are the same. And then service revenue, I started with a credit balance because it increases revenue. So I have a credit balance of 70,500. And then I added an additional credit of 8,700. So I'm going to add those two together. So 79,200. Rent expense, I started with a debit balance of 10,400. I added an additional 1,300. So I have on the debit side 11,700. Same concept with salary expense. I started with 23,800 on the debit side. I'm debiting an additional 5,400, so I'm going to add them together. So that's 29,200. Oh, there's a lot of accounts. Now, supply expense, I started with nothing and then I debited 220. Utility expense, I didn't change that. And then depreciation expense, I added 900 with starting at 0. Depreciation started with 0, added 1,200, and interest expense 160. Okay, so that should help you on that one on how to add all those together. Okay, so for this one, we're determining whether it's going to be what's going to happen based on cash versus accrual basis of accounting. So accrual basis of accounting is we only record revenue when it's been earned, and we only record an expense once we know the amount and we know we owe it. Doesn't matter when we receive money or when we pay money. So for May 5th, we received and paid an electricity bill. So in the cash basis of accounting, our cash went down, right? And our utility bill, our expense went up. The same actually happens here with our accrual basis because we received the utility bill and paid it at the same time. Now, here on May 9th, we received cash for meals served to customers. So we received the cash at the same time that we earned that revenue. So cash and accrual would be the same. The 14th, we paid for kitchen equipment. So we paid for kitchen equipment at the same time we received it. So that would be the same. May 23rd, we served a banquet on account. So this is going to be different. So if we're just using the cash basis, we are going to receive we're going to record the revenue only when we receive the money. So that would be 0. On the accrual basis of accounting, we actually did the work, we've earned it, regardless of when we get paid for it, we still have earned that. So we're going to go ahead and record that there. So we made an adjusting entry from May 1st. So prepaid rent, if we're doing the cash basis of accounting, that would not change anything. For our rent, what I'm going to do is I'm going to take $1,800 that we prepaid for 3 months. So we're paying $600 a month. We want to now account for that 1 month. So it would be -600. And then for salaries, we accrued salary expense of $1,900. Cash basis, we know cash has gone out the door, so we're not going to worry about that. Accrual basis, we are, because we know the amount and we know we owe it. So we're going to go ahead and record that. And then finally, depreciation, cash basis, we're not going to have any, but for depreciation here, we're going to subtract 40 for our expense. All right, so I would say that when you're looking at what gives you a better picture of what actually happened, definitely the accrual basis gives you a much better picture of what's going on, and your more accurate financial statements, okay? So for number 3, let's see what is going on here. So they've already done A for you, so let's talk about B. Employees are paid $3,000 on Monday following a 5-day work week. October 31st is a Friday. So if October 31st is a Friday, they have not been paid for that week, but they have earned it. So we need to go ahead and account for 5 days worth of work because they're not going to get paid until the following Monday, which is in November. So what you're doing with B is you are increasing your salary expense, and you are also increasing your salary payable. So your salary payable is a liability on the balance sheet, and your salary expense is an expense that lowers equity on the income statement. So company paid $440 on October 1st for 6-month auto insurance. The company recorded the prepaid. So as of October 31st, we've now used 1 month worth of insurance. So if you think about it like this, if we were to cancel on October 31st, we would not get the whole $440 back. So what I'm going to do is I'm going to take the $440 and divide it by my 6-month policy. So we're paying $73.33 per month. So to make that entry, I'm going to go ahead and lower my prepaid insurance, which is an asset, and also lower my equity with insurance expense by $73.33. So for D, the company purchased office furniture for $8,300 on January 2nd. The company recorded the office furniture, and annual depreciation is $1,000. Well, if we're just doing October 31st, then we want to do 10 months worth of depreciation. So I'm going to take my 1,000, I'm going to divide it by 12, and multiply it by 10. So we should have depreciation expense, a debit, which goes on the income statement of $833.33. And then we're going to have accumulated depreciation with a credit. Accumulated depreciation goes right under that office furniture on the balance sheet. The company began October with $50 of supplies on hand. On October 10th, the company purchased, and the company blah, blah, blah. Okay, so what I want to do is to find out how much we used, I'm going to take my beginning balance. I am also going to add what we purchased throughout the month. And it had $120 of office supplies. So it used $120 of office supplies. So, excuse me, I don't need to figure out how much I used. I'm just going to go ahead and lower my office supplies with a credit and increase my office supply expense, which decreases my equity, with a debit of $120. So F, the company received its electric bill on the 30th, but did not pay until November 10th. Well, we have an exact amount and we know we owe it, so we're going to go ahead and record it. And I'm going to record utility expense and utility payable. And then the company paid November's rent on October 30th. So then I'm not sure if there's anything you need to do here. So the company paid rent for November on October 30th. Well, I guess technically it could be prepaid, but we're only looking at a day there. I'm not sure that that's something that we need to record and then go ahead and reverse with an adjusting journal entry. All right, let's look at the next. Okay, so in this case, we are going and doing the regular journal entries, and then we will account for some of the adjusting journal entries. So we paid rent. So we have prepaid rent covering 5 months for $6,000. And we have prepaid insurance here, it looks like, of $3,900. And we collected $10,000 of cash in advance from customers. So I'm going to increase my cash. And this is unearned revenue, which is a liability because we haven't earned it yet. These services will be earned $2,500 monthly for 4 months. Collected $4,000 cash in advance from customers. So again, and unearned revenue. Okay, so then we need to go ahead and journalize the related entries. So let's go back to the first one. So the first one was we had prepaid rent as of November 1st. Well, it's December 31st, so we've used 2 months worth. So let's see what we've got here. So 6,000 divided by the 5 months, so 1,200 a month times 2 months that we just used. So we have 2,400. So I am going to lower my prepaid and increase my rent. Was it rent? Rent, yes, rent expense by 2,400. And lower my prepaid by 2,400. So then the next one is our insurance. So we, okay, so we had $3,900 of insurance covering 3 months. So $1,300 a month, ending January 31st. So it looks like as of December, we had 2 months worth that we used. So 2,600. So I'm going to have insurance expense of 2,600. And I'm going to lower my prepaid insurance by 2,600. We collected cash in advance, so the service revenue will be 2,500 over a monthly period. So we've only incurred, it looks like, $2,500. So I'm going to change my unearned revenue. I'm going to lower that 2,500. And I'm going to increase my regular service revenue by 2,500. So that's 1 month's worth. And then collected $4,000 on December 1st in advance. The service revenue will be $1,000 a month. So again, I'm going to lower my unearned by 1,000 and increase my revenue by 1,000. Okay.